Welcome, class, to Chapter 12, the Capital Budgeting Decision. While early comments on administrative procedures and accounting considerations are helpful, the major thrust of this chapter is on the various methods for ranking investment proposals. The basic selection methods are established. Mutually exclusive versus non-mutually exclusive events are compared. In the reinvestment assumption, capital rationing, and the net present value profile are presented. This chapter continues with a comprehensive discussion of procedures for depreciation write-off and integrates the resultant cash flow determination with the capital budgeting decision. There is also a presentation of a replacement decision which examines the process of selling an old piece of equipment and replacing it with a new version. The tax consequences of replacement are carefully examined and included in the example presented. The chapter outline considers a capital budgeting decision represents a long-term investment decision. That cash flow rather than earnings is used in the capital budgeting decision. That the payback method considers the importance of liquidity but fails to consider the time value of money. The net present value and the internal rate of return are generally the preferred methods of capital budgeting analysis, and the discount or cutoff rate is normally the cost of capital. The capital budgeting decision administrative considerations center on the fact that capital expenditures are outlays for projects with lives extending beyond 1 year and perhaps for as many as 25 years for things like utilities and oil and gas companies, that intensive planning is always required, that capital expenditures usually require initial cash flows often large with the expectation of future cash inflows. The differing time periods of inflows and outflows require present value analyses. The longer the time horizon associated with a capital expenditure, the greater the uncertainty, and various areas of uncertainty are annual costs and inflows, product life, interest rates, economic conditions, and technological change. The capital budgeting procedures also include search and discovery of investment opportunities, collection of data, evaluation and decision making, and reevaluation and adjustment. Let's take a look at a capital budgeting procedures flowchart and give this careful review before moving on. When we consider accounting flows versus cash flows, the capital budgeting process focuses on cash flows rather than income. Income figures do not reflect the cash available to a firm due to the deduction of non-cash expenditures such as appreciation. Accounting flows are not totally disregarded in the capital budgeting process. Investors' emphasis on earnings per share may, under certain conditions, require use of income rather than cash as the decision criterion. Top management may elect to glean the short-term personal benefits of an income effect rather than the long-run cash flow effects, which are more beneficial from the owner's viewpoint. Here are some more of those points just mentioned to review. Let's take a look at the cash flow and revised cash flow for Alston Corporation and try to apply some of the things that were noted in the last couple of slides. We're going to end this segment on the fact that the methods of ranking investment proposals center on 3 specific methods that are quite detailed: the payback method, the internal rate of return, and net present value. So please memorize those, and we will pick this up again in Lecture 2 and go over those in detail.